Thank you so much for joining us today. I am Marche, the webinar director here at Advice Chaser. And as you come into our webinar room, I do want to do a little bit of legal housekeeping to get us started. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number and email address as well. We're happy to reach out to you after today's event to make sure that gets addressed. Again, we want this experience to be as educational as possible. So please don't hesitate to ask for clarification or expansion of the material. Chris and I have worked together and prepared lots of questions that we would figure people would be asking, but we can't anticipate everyone's question. So please ask if you have some more questions. Well, I'd love to introduce you to our presenter today. Let me go ahead and pop this up here. As COO of Grassland Capital, Chris Deneff has the opportunity to merge his education experience with complex compliance regulations, and most importantly, his passion for helping clients achieve their financial goals by adhering to only the highest standards of client service. Chris began his financial career at RSM US LLP, a top-tier accounting firm where he worked in the real estate consulting group, providing lease analysis and consultation. And then in the private client services taxation group with ultra-high net worth individuals and families. From there, he formed MJ Solutions, a private consulting firm that provided custom business and operations plans to over 50 business entities. With his unique educational and professional background, Chris brings a modern and fresh approach to wealth management and investing that is steeped in a solid foundation of expertise with due diligence, data analysis, and contract compliance in a variety of highly regulated industries. As a result, Chris is able to seamlessly navigate clients through financial regulations, tax issues, and more, with an emphasis on building long-term relationships through transparency and trust. And Chris, we're so excited to have you here today. This is a heavy topic, very technical, so we're excited to have you present, and I will keep you on your toes. If there's anything I don't understand as a layperson, I will ask. So let's get going.
Perfect. Wonderful. Thank you, Marche. And just before we jump in, as you mentioned, this is a very technical topic. This is not per se high finance, but it's a little bit more involved with alternative investing and some of those mindsets. With that in mind, both Marche and I have worked together before. We want to keep this webinar to be less of a lecture, more conversational. So if anybody in the audience has any questions, comments, concerns, please feel free to pop in while we're doing this. It makes things a little bit more interactive. And while we have some of these examples in front of us, it gives us an opportunity to dive in. I do want to touch base before we jump into the slides on just an overall, not more compliance per se, but just a little disclaimer. Options and stocks are two different types of securities. And I just want everybody to be mindful before we get into this, that options are a derivative security that does have a time expiration. So without having a proper theory behind any of the examples that we're going into, it becomes more and more speculative, right? So when we invest in the markets today, sometimes you have a little bit of wiggle room, whether you're right or wrong. You could have bought the S&P on Friday, and by today you would have been down a little bit, or maybe back up, depending on what your entry point is, but you still own those shares, right? An option is a time-weighted instrument, which means if you don't utilize it to its potential or recognize it before it expires worthless, unless it's converted, if it's past its strike price, which is what we can get into. But it's important to note that options are more of an active instrument, and it's something that if you have an option position open, as an open interest is what the term that we'll talk about, you want to be more involved in the process, because again, it can be speculative if you don't have some type of supporting theory behind it. And so we're going to go over a little bit about what is hedging. We're going to go over why we can use it to minimize risks, but also we have to keep in mind that the theory behind this, what we're using to support our theory for why we should use hedging, is capital preservation. We're not using hedging to go out and hit a home run. We're going to use hedging as a technique to negate any market downturns. And as you'll see when we get into the slides, like a hurricane or hurricane insurance, now is not the best time to hedge. You want to buy hurricane insurance when the hurricane is a category 1 or when the market risk is low, not when you're in, as of yesterday, for example, one of the worst days in markets in the last 2 years. You don't want to be hedging now. So Marcia and I picked a great date to have this conversation today because of everything that's going on. But I do want a couple of those disclaimers as we go forward. So Marcia, if it's okay, we'll jump forward here.
I will just say, I will just say to our audience, you use the word options and derivatives. So if you don't know those terms, we will be getting to those. So I just want to say, hold tight, we'll get to those. And if you have any other vocabulary questions, go ahead and put that in the chat and we will pause and define those.
Perfect. So as we get into hedging strategies, something to keep in mind is risk management. And I mentioned capital preservation before, but it's important to consider whether you're using simple techniques for investing, more advanced techniques for investing, or if you're using an advisor. It's still imperative that you consider risk management in anything you do. This is a great webinar for engineers because risk is something that's built into your jobs daily. And it's something that as a more skilled technician, you're more familiar with than maybe like, as Marcia would say in the most general way, the average layperson. And so when you're keeping risk in mind, you're making an election to try to choose financial independence, either with your retirement accounts or with some of your private investments. But you have to consider the difference between perceived risk and actual risk, right? You may think that something is risk-free because it's being managed by a notable investment manager or because it's tracking the market. But in reality, those real risks may be different. And so let's keep that in mind as we not only talk about these strategies, but as we just look at the market as a whole and make sure that we're not just looking at something of what it could be, but we're considering things of what will happen if things go wrong. And so for anybody that's in the field of investing, either as the investor, the investee, the advisor, you want to just make sure that you are clear with your expectations of risk management, how much risk you're willing to take, and you also acknowledge the potential downsides, not just the upsides of investment management. So that being said, let's talk a little bit about what hedging is and how it's traditionally used to protect your investments. For anybody that's on the call today, something to keep in mind, if you have any sort of asset, such as a car or a house, you probably have homeowners insurance, or you probably have car insurance. If you're well-versed into your career and you have a pretty solid investment account, either it's for retirement or just for your own personal trading, what are you using right now to protect against any downside risk? What we call that, if you're actually actively managing it, is portfolio insurance or hedging strategy. It's something that you're going to want to use to protect against any downside in the market in times when you see things like yesterday happen. And so hedging is a strategy that uses options or a derivative and it's usually used by hedge funds or large-scale investors to protect against that downside risk. For individual investors, hedging is a great strategy to consider as you're closing in on retirement age or a time in your life where you're going to need to leverage the cash in your portfolio, because we'll go through two examples here and you'll see if you rely on your portfolio for either retirement or for a large cash purchase at a time right after it's taken a substantial downturn in the market, you're really missing out on some opportunities that could be arising from maybe a turnaround or a bounce back, but also you're taking out a large percentage of your cash or your investments that used to be a lot bigger. And so keeping that in mind, what we'd like to do is go over two examples from 2000 and 2007. We'll see those, how they work in the next two slides.
All right, I have a
for
couple
our
questions
first
here
model.
before we get
Sure.
going on that, Chris. So a couple questions here. When you talk about portfolio insurance, it's not an actual insurance product, correct?
No, this is something that is akin to insurance, but it is not insurance. It's just something that you can relate to, right?
All
Your
right.
investment account in some instances may be more valuable than your home, but it's exposed to more risk than your home is. So if you have homeowners insurance, you should consider, or at least inquire about some type of coverage, right? Or some type of strategy that protects this large asset. And that would be hedging.
All right, great. Here's a question. Why is this strategy only typically used by hedge funds and large scale investors?
Sure. So we mentioned in the beginning that options is a type of financial instrument that requires very active involvement. You're dealing with something that expires, and it will expire worthless if you're not doing anything with it. And so large-scale investors that have teams of investment people or investment advisors and hedge funds that are actively involved in trading and doing data analysis on the day-to-day can see the change in risk environments that happen in the markets, not only over the course of days, but over the course of weeks and months and quarters. And that gives them the opportunity to strategically hedge when hedging is cheap and when risk is low. And so that if things turn around in the market, they've protected a subset of those investments. Hedging is something that's used by them because of the fact that this is their job, right? They're involved in the markets on a day-to-day basis. And so they not only know when's a good time to hedge, but they also know when's a good time to remove the hedge. This is, in some respects, very contrary to a set it and forget it mindset, which, while commonplace and very appropriate for passive investing, it doesn't do a lot for you on days like today or yesterday if you're coming into a time where you're going to be retiring or you're going to need the cash in your investment portfolio for something. And now today or year to date, it's worth 13 or 14% less than it was on January 1st. And something to consider is if my investment portfolio is worth 15% less than it was, if I'm taking out a fixed amount of capital each year, each quarter, each month, it actually becomes a larger and larger percentage of the portfolio as a whole. So we want to prevent that, right? And we want to be active in caring for those things.
So one more question here. You talked about how it's important for investors who can't wait for the market to recover. And by the way, the time of the recording is September 14th, 2022. We did have a fall in the market recently. And so just if you're watching this recording and the market's up, hopefully, that won't necessarily apply to today, as we're saying. But can you talk a little bit about the kind of investors that hedging would be most applicable to, that they're the most exposed?
Sure. So in the biggest generalities, as investors get older, and in most cases, the large amount of assets that are in investment products are contained in retirement accounts. You've traditionally heard about the shift of taking your 60-40 stock bond portfolio and you're slowly moving those over to more safe investments. What we want to consider is that as you get older, you want to take risk off the table, but you also want to have the opportunity to capture those investment gains. And so if you are at a point where you foresee yourself retiring in the next 5, 10, 15 years, you should really consider asking yourself, what happens, or what if, or what will my portfolio look like if there is a significant drop in the market? And we can look back historically and we can ask ourselves, in the next two examples is a great start, using $1 million as an example, how long does it take us to get back to that million starting point? And what have we missed by conveniently or inconveniently deciding to retire in that time frame? And so hedging model A is just a starting point at 2000. And in the category on the left here, without hedge, what we'll do is we'll show the portfolio over the course of years to date through 2021 of where it would be and what it would look like if you just tracked the market. So between years 2000 and 2002, you would have seen a portfolio go from $1 million by the end of 2000, starting at 2000, by the end of 2002, if you go over to the cumulative P&L, down to 587,000. So you've lost about 42% of your portfolio. And the colors right there show that you're actually down on the portfolio all the way until 2012, okay? It really takes a long time if you just sit it in the market and you wait things out to get back to that $1 million, because keep in mind, not only you had 2000 through 2002, but you had a almost 40% correction in 2008 as well, which doesn't really help you when you considered you almost get back to even in 2007. So keep that in mind as we shift over to talking about a 50% hedge. And I want to be mindful of two items in the differences in the categories. Without the hedge represents a true track of the market year to year. And you'll see that reflected in the cumulative P&L categories and then the P&L percentage and the P&L dollar signs. With a 50% hedge, what we've done is we have said, let's take a 1% of our portfolio and let's put it into a hedging model. And like I said before, the options will expire worthless. So we're sacrificing 1% of the market's gains to insure against a 50% drop in the portfolio. And what we'll see is that instead of being down 11.5% in 2000, we're only down about 5.75%. You can see that in 2001 and 2002, accordingly, you're only down half what you would expect to be, which is great. But now you may be considering, well, what are the actual costs of that? And you can see that in 2003, where the market was up 25%. But again, you hedged, right, that year as well. So you only made 24%, but you're actually almost back to scratch in 2003, at the end of 2003. Whereas if you hadn't sacrificed that 1% and invested it in a hedging model, you would still be waiting to the end of 2012. So 2003 to 2004 is a turning point for somebody implementing a hedging model, because now they're back to that $1 million mark and they're in the green. Same thing applies down here in 2008, whereas instead of being down 38%, you're down 19%. And you do see a little bit of a decline there. But the sacrifices that you made to offset that drop pay up well in dividends, not literal dividends, but as you start to see the account go forward. And so the question to ask yourself is, if I'm retiring and it's 1999, or if I'm thinking about retirement and it's 2004, what should I be considering doing as I want to start looking at tapping into this portfolio? Because you don't want to be in your late 50s or early 60s, or if you're really eager, in your late 40s in 1999, thinking that you have $1 million saved up, only to realize that it's going to take you to 2013 to actually be able to tap into that portfolio with the same cost of living expenses. And so that's a good outline of 2000 and 2008 to consider both of them. With Hedging Model B, for some of our younger employees that missed the dot-com bust and didn't have to deal with some of the fallout there, let's say you started out with $1 million in 2007. You're still in the same scenarios. You're down almost 40% in 2008. It takes you to get back into 2013 again to where you're past that break-even point. Whereas in the 2008 example, by 2009, when the market had a great year being up 23%, you've made 22% by hedging, and you're already in the green. Now, what's important about this model in both of these instances is in each year, you would make the active decision to implement a hedging model. That is not necessarily the case if you were to go forward, because there would be years where maybe risk would be low of a market downturn and you might not put that hedge on. But you could see that a very conservative 1% does offset a pretty substantial downturn in the market. And those numbers do carry forward. Just in 2021, for example, if you're starting with $1 million, you end up almost $800,000 wealthier in that particular $1 million account than you would if you had just ridden out the market. You would still be up without the hedge, but that's a substantial enough amount of money to really consider the difference between the two. So with those two in mind, I will pause just for some questions, if any, or Marche, because I know we got into the nitty-gritty there.
Once we get into nitty-gritty with the spreadsheets, sometimes it is a little difficult. So explain again why in like an up market the investment portfolio with the hedge is 1% down. Explain that again.
So what you're doing is you're taking 1% of the value of the portfolio and you're using that to purchase into the hedging model, right? So there's two types of hedges that we can go over here for the purposes of protecting against an investment account. The standard hedge is something that you would want to consider in times of, let's say, a 5 to 10% bear market drop. It's something that you can pop in and pop out of pretty easily, right? They're relatively inexpensive relative to the portfolio as a whole. They have a short time horizon, which means that they are, going to expire within maybe a year or 6 months of the like. And it's something akin to maybe like an annual insurance policy. A tail hedge, to go right off the slide here, is really like catastrophic insurance. It's substantially cheaper than a standard hedge. And it might be something that you put on in cases of a high risk environment, right? Anytime that the market just cataclysmically fails, a tail hedge would be the one that would take the value and really pay out properly. The reason why we talk that it doesn't do much in a bear market is the threshold for a tail hedge to be valuable might be a bigger drop than a typical bear market 10%. It might be that a tail hedge needs a 30, 40, 50% market correction, something that's really a black swan event to pay off. And so those are two of the different strategies that you can employ, either independent or in conjunction of each other. But it's just important to consider that, you know, there is a big difference between a standard hedge, which would be like regular portfolio insurance, and a tail hedge, which is more keeping in mind catastrophic events.
All right. And then just a clarification on what you put hedges on. So do you put a hedge on each of your investments? Like, so for example, if you own Apple or another, you know, stock in another company, do you hedge that particular stock or security, or how does that work?
So you traditionally would put hedges on a stock market index, whether it would be the NASDAQ Composite, the Dow Jones Industrial Average, the S&P 500 index. You want to be as broad-based as possible. And so to give an example similar to homeowners insurance, you wouldn't, if you feel like your kitchen's going to flood, you don't really want to just insure your kitchen, right? You might get a flood in your bathroom and then you're not covered. So if you were to put a hedging model and implement it with maybe one stock, for example, like Apple, there might be a situation where the market as a whole fares much worse than Apple, even though Apple does take a drop, and it doesn't offset the losses in your portfolio that you're truly looking for. And so unless you have a single stock account where you're exclusively investing in one stock, right? I've put all my eggs in my kitchen, literally. You want to make sure that you're protecting against the broad-based market, right?
All right.
And, you know, there might be a case where, you know, Apple goes down and the market goes down. You just don't know, right? So having that broad-based exposure, and then what we'll do is when we get into talking about pricing as well, you know, you want to be in investments, especially because of the fact that options expire, that are highly liquid. And even though Apple has tens of millions of shares that trade each day and a lot of option contracts in play, you want to look at indices because more of the market is involved in options in the indices. And so as you want to exit, as you want to sell the shares or sell the option contracts or exercise them, you want to be in a position where you can do that at market price, right? The difference between the bid and the ask is important in this case.
All right. Well, let's get into it a little bit more. Talk about when hedging investors and advisors know when to actually go ahead and put in a hedge on.
Sure. So when you start to get in times in markets when risk is high, and some of the conventional wisdom that Warren Buffett would use would be, you know, you want to be fearful when others are greedy and greedy when others are fearful. When you see markets making all-time highs or recent swing highs, or any time when you feel like there is an increased amount of risk, when you see people piling into the markets on both the retail and the institutional side, you want to be mindful of this, right? Because there could be an opportunity where all of those people realized, or some of them, that they've bought in a very expensive time. And so that would be an opportunity when risk would be at a higher time. And you would consider at that juncture to probably put a hedge on your investments in order to take some money off of the table. Now, the interesting thing about that is that when risk is high, the options themselves in some of these hedging models may be more expensive than they normally would be. And so you want to somewhat forecast where you feel like, if you feel like risk is increasing, that might be a good opportunity to hedge. You don't have to be perfect. You don't have to call the top. You don't have to call the bottom. You know, what the advantage of the hedging mindset is that if the market continues to go up, that's fine. That option, that model will expire and it'll take that percentage, much like an insurance premium where you don't have a car accident within those 6 months. That's great. If things turn down and they roll downwards, you have coverage. You have that protection that you put in place. And so the way that the hedging model would kind of best be put is it's like getting hurricane insurance in the off season. If you feel like things are coming down the pike that may not be advantageous to your investing mindset, now is a great time to talk about hedging. For anybody that does have an insurance or a investment portfolio and they were looking at it yesterday, yesterday was not a good time to be calling your advisor or going to E-Trade and actually buying a hedge. It's not only very expensive, but chances are you've already missed the boat. So you don't want to be, standing on the docks, basically looking into the Category 5 storm, trying to call your insurance broker and putting the policy in place.
Mm-hmm. Okay, so let's talk. Oh, go ahead.
I was just saying, we did touch on this a little bit, with put options on indices and why. You want to be involved in models that are liquid, that are flexible, and that are fluid. Much like buying insurance from a premium company, you want to make sure that it's easy to get your premium and turned into a claim, right? And you want to get paid by that insurance company. In the same way, you want to be looking for hedging models that are generic, that are on an indice, that are easy to get and easy to get out of. You don't want to be in a position where you didn't buy a liquid index into a liquid index, and now it's become illiquid because it was already on the edge, and you can't recognize that price performance. You really want to make sure that you are involved in the same types of instruments that other market participants are involved in. So being active and really understanding how and why these are constructed is extremely important.
Okay, so you talked about put options. Let's go ahead and get into that, how that works. And then also, I know further on, we're going to actually look how you can gauge interest in a particular option. So let's go ahead and talk about put options.
Sure. So options in general are a contract. It's a derivative instrument, which means it's based on an underlying security. And an option, as it is in its name, gives you the option, not the demand, to buy or sell an underlying security at a fixed price, which is the strike price. Unlike, say, futures contracts, for example, I might enter into a futures contract for a specific commodity, and I am required to buy or sell the underlying commodity at a stated price. With options, there's a little bit more decision-making and scrutiny involved in the process because you have the ability to say no. You could buy a call option, and without the right direction, it could become very valuable, but it could still expire worthless because you didn't take action on it, right? So a put option specifically is a type of options contract that gives you the option or the right, but not the obligation to sell a security at a particular price. So an option also has a time weight component to it, and it has that strike price component to it as well. So options can be done in week, month, quarter, number of instruments. It all though depends on the market interest, right? If you open a put contract, if you open a put option contract and you buy a contract into it, you have to have somebody on the other side of the market that is willing to sell you that contract. So it's a twofold transaction, which is why in some instances you may see options that are less traded than others because there's just not somebody on the other side there that's willing to either open or close that contract. Yeah. Because of that time weight and that expiration date on there, it's a time weighted instrument. So you can't really set it and forget it, right? You need to be active in the involvement of opening these contracts or closing them or buying them or selling them. It really is more of a actively managed product.
All right. So this is an example. We did look up these numbers today as of recording. And if you can just walk us through what buying an option on the S&P, well, I guess let's let you explain it because I'm not the expert here.
Sure. So, and just to start, option contracts represent underlying securities in bits of 100. So when you take in mind the price of an option, it's the cost per share. So you always have to multiply that by 100. So keeping that in mind, when we started the presentation, the S&P was at $395 per share at the SPY index, the spider index. And at the time of the recording, we looked up the purchase price of a put option with a strike price of $385, which means we have the right to sell SPY for $385. Now, because it's an option, we could exercise that at any time. But because SPY is currently trading at $395, it doesn't make sense for us to do that, right? Because you could sell it on the open market for much more. And so what you're looking for is the S&P or the SPY ETF has to fall below the break-even price. And to calculate the break-even price, it would be the strike price minus the cost per share, which, if my math serves me correctly, should be around $362. So at that juncture, if SPY falls below $362 a share, your put option becomes meaningful, right? Now you have an advantage on the market that you didn't previously have before, because I have the right to sell this for something for more than what it's truly worth. And so at scale, what you can envision is the option would appreciate in value as the market falls below the strike price. And so the twofold approach here is, if the market falls below the strike price prior to the expiration date, you have an opportunity there where you could, if you were also holding SPY, actually exercise and get out of that position. You could actually cash out at a higher price than what the market is valued at. The other opportunity is you could sell the option contract itself to another buyer so that they could sell, or they could either exercise the option themselves. So you have two decisions. But the important point to recognize is that if the market falls below 362, that option has appreciated in a pretty substantial value, because one option contract represents the right to sell SPY for, the right to sell 100 shares of the ETF. So there is a leveraged component there, right? You're not purchasing the right to sell one share, you're purchasing the right to sell 100. So
one
I'm
other,
going to pause here to see if there's any.
Yes. So when you invest in the options market, you're doing so in units of 100. Is that correct?
Correct. So one options contract, the prices are shown, and this is what gets a little bit confusing. The prices are shown on a per share basis. And that's important because it helps you calculate the break-even price.
Mm-hmm.
But to actually be involved in the market itself, you have to purchase one option, and one option represents 100 shares. So I believe at $24 a share for your cost, you're looking at $2,400 for the right, but not, the obligation to sell the SPY ETF.
Right. So you're not obligated to share it, or you're not obligated to sell it, but you can.
Correct.
And then that the expiration date. So March 17th rolls around. If you haven't exercised your option, the option is worthless. Is that correct?
Correct. And so again, this is what being more active involves, is you have to consider you have a right to do something. But if you don't do something, you've lost that right.
Mm.
If you buy the ETF, if you buy SPY and you hold it throughout a bear market and a bull market, you still hold on to that paper. You own that ETF, that share in that ETF. If you open an options contract, so if you buy a put option and you let it expire worthless, it's done exactly that. It's expired worthless. So if you don't do anything with the $2,400 that you've spent, that $2,400 becomes zero. Now, in an example where the market goes up, that $2,400 might expire worthless, but the gains that the shares in SPY would have made, right? We would hope that that would overcome that investment. And that's what you saw in some of those other hedging models where you've sacrificed money to ensure against a downfall, but you're making a sacrifice. You're taking money and you're allocating it elsewhere as opposed to allocating it in the potential upsides of a market, of a bull market.
That's thank you for that explanation. I did have one other question here. Do you have fees that come with trading in the options market? Obviously, this is a break-even price, but are there additional fees?
It's going to depend on your brokerage. It's going to depend on your advisor. I can't speak to those exactly. You know, we're living in an era where there is a lot of free trading going on, and so it's going to depend on the platform that you're in. I will say this, that the fees, you should keep those in mind. They will be factored into your cost basis, and that's something to consider after the transaction has gone about, but they shouldn't be overbearingly shifting your decision point, right? Your option in this example that's $2,400, if your fees, we'll just say, are $100 right on top of that. So now you're in this position for $2,500. That means now your break even is 361 instead of 362. So those are going to be dependent on the investor themselves. It depends on the platform that they're on, but it is good. It is something good to keep in mind. It's just not something that I can speak to in detail. I think we lost you here, Marche.
I was just saying this is going to be my favorite part where we're going to look at the live data here. So can you explain what
Perfect.
the straddle is, and then I'll go ahead and pull that over on the screen.
So for anybody that's looking up what a straddle in an option market is, we're not going to talk about the strategy per se. We're just going to talk about the view of the straddle, partly because it just gives us a nice look in Yahoo Finance of how to see the two different options and how to actually understand the pricing, as well as what we talked about with open interest. And so what we're going to do is we're going to go down to that $385 mark. What's nice about Yahoo Finance is it breaks those up pretty nicely. The strike price runs down the middle. On the left, you have your call option. So a call option is the right to buy an underlying security at that strike price. A put option, again, is the right to sell that underlying security at that strike price. And so we're going to go down. We're at our March 17th, 2023 expiration date, which means we have to exercise that option prior to then, or it expires worthless.
What are we going down to again? What was it? The
385, please.
385, sorry.
385. Yeah, and the reason that we picked 385 was because you can see that there are all kinds of different price points because of people that have opened options contracts in this particular index all across the board. And it's nice in this case, you could see they're almost in dollar increments. What you will see though is you'll see in the far most right column, you'll see an uptick in volume. And what that is $385 is, because it's a nice even number, there's a lot of open interest, which means right now there are currently 18,586 open contracts, open put option contracts that have not been closed prior to March 17th. And so this would be a great example of an instrument where there's a lot of interest. So there's a lot of opportunity to both jump in and jump out. And you want that for an option because just because it's trading at a certain price, you might not necessarily get that price if you want to sell it. So you want liquidity in this example to actually get in and get out. And you'll notice it's kind of interesting. It's a pretty substantial difference. If you just scroll up just a little bit, the off dollar amounts are pretty tremendously different, right? You've got on the 385 side, you've got almost 19,000, 18,500 open contracts. If you go down to 380, you've got almost 31,000. But in the middle there at 383, 382, you have a very, very little amount. And so you need to keep that in mind if somebody is going to be doing the hedging model with you, if you're going to be doing it by yourself, if you're going to have an advisor do it with you. You want to be putting yourself in these positions where you're looking at an index, but you're also looking at an index from a position of an exit. If I need to get my money out, do I have somebody that's willing to pay me to get out? Because again, we're talking about these options contracts from the position of a buyer. We are the ones opening the contracts. We're buying the contracts, right? So we have the right. So we have to find somebody else who wants to pay us more for that right than we paid in an ideal world. And so by sticking with those numbers with higher open interest, there's a good chance that we can find somebody in the marketplace that's willing to pay us to get out of those contracts.
Very interesting. And I will note here, this is fluctuating all the time. So it's interesting. I think it was down a little bit $1 and up a little bit $1. So that's just the stock price, correct? Or no, it's the stock price of the trust.
This is the price of the ETF to date. So
oh, sorry, I said stock.
It's now at 393.5. That's okay. That's okay.
I'm a layperson. That's why we've got a advisor on here. Okay, great. Let's go ahead and move on. I know we're getting to the end of the hour. If you can just give us we'll probably run over a couple minutes. That's all right. If you have to go, don't worry, there will be a recording that will be available to you.
We did talk about this at the beginning, and I just wanted to reiterate now that we've gone through the process, the decision tree that we're going to evaluate over the course of, do we like hedging? If so, what happens when we have an opportunity to put it on? The best practice is to use some type of professional or somebody that's involved in the day-to-day. I would caution anybody that has a do-it-yourself mindset, not to say that it can't be done, but just be mindful of the fact that because options and because derivative securities often have expiration dates, there is a chance that the value could be zero, not because the underlying security went to zero, but because the time expired. And so if you are going to evaluate a hedging model as a strategy for you, for your family, for a friend, just consider that you will need to be a little bit more involved on the day-to-day. I would caution anybody from saying that this is something that you can put on at the beginning of a round of golf and pick it up next week when you're about to check in at the tee box. It needs to be something that you look through and you work with a little bit more frequently. So in this case, the best case would be use an advisor. This is their day job. Ideally, they should be the ones tracking this. And it also helps you kind of avoid emotional investing, right? The thing about hedging models is you want to be able to see the big picture. You have to have a theory behind why you're getting in and why you're getting out. And part of that means you may want to wait to get out at a different time, and being able to have somebody to bounce those what ifs off of is oftentimes really valuable. And again, yesterday is not a great way to get into hedging. January would have been a great time to get into hedging, right? So if you do work with an advisor that is in the options market, or if you are involved in the options market yourself, start to think about opportunities to get in where you're more of a rare mindset, right? You want to find the opportunities before they present themselves and do so in a cost-effective manner. Again, to reiterate the cheesy hurricane insurance mentality, you don't want to be standing on the dock of your house in Mobile, Alabama, looking at the eye of the storm, wondering if your policy check made it to the insurance broker. Not a good time. So,
And
and that does
probably goes
transition
to
pretty
that.
nicely to when is it time to hedge? You know, you want to look at opportunities when risk is low because you're seeing the run up. When risk is low, the option prices become lower. And you can see that reflected in Yahoo Finance is a great free way to kind of peek in and look around and see where you're at. You don't want to time the market though. You have a finite amount of time, right? And so you can always reinvest into a new policy, right? If you have to. If March 17th comes and goes, there will always be another opportunity to hedge. So the goal is not to get in super cheap right at the top, right when risk is about to turn high and you got this great deal. You know, I haven't met anybody to date that after a car accident calls me up and tells me how happy they were that they bought insurance for such a cheap amount of money the day before the accident. They're just glad that they have insurance and that they're covered, right? That's the key, coverage.
I think we already
And then
covered this a little bit, but you know, just to reiterate this.
Sure. So again, with hedging, you know, it's a small amount of money. You know, your homeowner's insurance premium does not cost the same as your home. Your car insurance premium does not cost the same as your car in most cases. You don't want your hedging model to encompass a majority of your portfolio, right? You want a little, very conservative investment where you're saying, I have a theory or I have a belief that the market in the next 6 months might be lower than it is today. Let's take a little bit off the table. Let's allocate it out to the hedging model. If we're right, great. If we're wrong, all we've done is set us back a few basis points. That's a pretty good risk reward. And I just want to be clear again, this is not options trading. You are not actively looking to exploit the prices of options on a daily gain basis. You are buying protection for a long-term event that you foresee in the future. The volatility in options changes daily, the prices change daily, but you're looking for an entry and an exit point.
All right, well, we're going to wrap this up really quickly. Talk to us about what is next if someone wants to add hedging to their portfolio strategies.
You know, before even asking an advisor about hedging, I think that the best thing that you can do is familiarize yourself with just the types of options that are out there, the types of opportunities that are out there. And then if you do have an advisor, the questions to ask are more along the lines of how familiar they are with options. And from there, you can then transition the conversation into how familiar they are with hedging. This is a little bit more of an alternative strategy, but it's something to keep in mind if you are more technical and you understand the flow of how these instruments work. It's a really powerful tool that will put you in a position where you're starting to manage your investments or your advisor is starting to manage your investments more like institutional investors, more like alternative investments like hedge funds. The word hedge fund really does come from trying to hedge against risk. It's since turned into an industry with a lot of different caveats, but it's important to keep in mind that you're using tools that a lot of, I would say, non-retail investors are using. And it's just important to be mindful of that. So it's also a risk. So just again, be mindful.
Well, we have gone over a little over time today, but I appreciate folks for hanging in there. We did try to cover all the questions we got during the webinar itself. So if you do have a question that we did not get to, go ahead and leave your contact information in the chat and we'll go ahead and reach out to you. On behalf of Advice Chaser, we want to thank Chris and the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. We will look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, thank you everyone for attending. Once again from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye-bye.
Perfect. Thank you.